TripleNet Investment Group would like to introduce what you need to know about the 1031 exchange. First off, we'll start with the 3 different methods that you can use. The first method is to identify 3 properties of unlimited value. It's the most common method. Second, identify an unlimited number of properties whose aggregate fair market does not exceed 200% of the value of the property sold in the exchange. And third, if the exchanger identifies more than 3 properties and their aggregate fair market is value in excess of 200%, the exchanger must purchase at least 95% of the value of properties identified. There are some restrictions. One, the exchanger has 45 days from the date of the sale of the first relinquished property to identify potential replacement property or properties, and a total of 180 days from the original sale to purchase the replacement property or properties, aka 45 to 180. Second, the exchanger must acquire replacement property of equal or greater value, obtain equal or greater value debt on the replacement property, reinvest all of the net proceeds realized from the sale of the relinquished property, and acquire only like-kind property, aka equal or greater value. Exchanger must own the investment property for at least 1 year before he can claim it on the 1031 tax exchange. Not too hard. Exchanger must initiate the 1031 process before the closing. Once the closing occurs, it is too late to utilize the 1031 deferred exchange. Lastly, exchanger may use the vacation house or primary residence for 1031 exchange as long as the property is reported as a rental or business use on the tax returns for 2 consecutive years. Now, there are advantages to using this and disadvantages, but I will go over the advantages first. The first advantage is when selling real estate, if you sell and reinvest, you will pay income taxes on the realized gain. However, with the 1031 exchange, you will defer the tax gains. You may have management-intense rental properties and would prefer to transfer your equity to ease of ownership to single-tenant properties such as Walgreens and stuff like that. You may have been holding on properties long after their appreciation has topped out. You can start rebuilding your equity by disposing of those investments and acquiring new ones. You may have some non-income producing real estate such as raw land. You could exchange this property for another asset that would not only give you cash flow, but it would get you income tax deductions such as depreciation, which you do not have with your raw land. This means more money is available for acquiring your next investment. It can be regarded as a free loan from the government. You may have owned a leveraged property long enough to accumulate a considerable equity. You now have an opportunity to exchange it into a larger asset and reposition your equity to your benefit or that of your heirs without paying taxes. We highly recommend using professionals that have experience in 1031 deferred exchanges to guide you and ensure you're in compliance with government regulations. And last, with proper real estate planning, you can keep exchanging properties throughout your lifetime. Neither you nor your heirs will ever pay income taxes on the gains by doing a tax-deferred exchange. The disadvantages are: exchanger will have a slightly lower depreciation schedule when acquiring new properties. This is because the IRS will look at a new tax basis as being the same as the previous one, less the deferred gain. Exchanger also loses on the income tax return because it cannot be deducted if you exchange property rather than sell it. If you want to take a loss, just simply call it a sale, not an exchange. Well, I want to thank you from TripleNet Investment Group for watching this video. For any questions, just look at the telephone number, fax, or email. Thank you.